Let's get to your closing bell on Wall Street for Thursday. There is your closing bell for this Thursday. Let's check out how the markets reacted largely to the positive CPI print. We got at 8:30 this morning. If you were up and watching the markets, the futures dropped initially, did not like what they saw in this report, as it was about exactly what estimates predicted. And then they rallied. You see the Dow finishing up 216 points, the S&P a slight gainer at 13, about 0.3%, the NASDAQ up about 70 points on the day. For a closer look at the broader markets, let's bring in Crossmark Global Investments Chief Market Strategist Victoria Fernandez. Nice to see you, Victoria. Your read on what the market saw in the CPI print today.
Yeah, I think you're right. When you speak about the market really going down at first, that kind of knee-jerk reaction, excuse me, when CPI came out this morning, I think it is because every element of that report was as expected. Both headline numbers, core or the headline and the core for year over year and for month over month, all as expected. And I think there were some people out there that really wanted to see that be better than expected because they have the anticipation that then the Fed is going to change their outlook. Nothing that happened today, in my opinion, changes what the Fed is going to do. We've been anticipating for the last couple months that the Fed would do their 75 basis point hikes through the end of this year, and then they would move to 25 basis points for the first two meetings of 2023. We still think that's what they're going to do. Their higher for longer mantra has not changed. You even had Bullard out today saying there's not enough upside risk for inflation that the market is pricing in right now. So it just tells you they're not going to change. And I think that's why we saw so much volatility early on in the markets, combined with the labor information that came out, which is not positive for what the Fed is going to do. All of that was kind of a negative draw this morning, but the markets rallied and they ended up a little bit.
Well, Victoria, what does all this then signal for equities, at least over the next couple of months? If you think the Fed is going to continue on its path right now, continue to raise rates, does that mean we should expect to see more volatility then for the market?
Sean, I think that's absolutely what we're going to see in the markets. You know, last year, our whole theme for the year was a tug of war. And I think we're going to continue to see that. Just because the calendar changed does not mean what's going on in the economy has really changed. And obviously, tomorrow we're kicking off earnings full steam with the banks. That's going to set a tone for sure. But as we go through the next few weeks of earnings, I think that's going to build in with what the Fed is looking at. They've told us they need the labor market to weaken. I mean, look, we had initial jobless claims, continuing claims, the 4-week average for claims all come down. So the labor market's going to continue to be strong. I think the Fed is going to continue to push back against the market. Again, that just means more volatility. So you've got to position your portfolio in order to take advantage of that.
When the Fed looks at this report today, Victoria, what do you think is the most concerning aspect of it?
Well, services is where they're really looking, right? We all knew that the goods component was going to come down. We were going to see deflation there, and we did. Most of that due to the energy component. But the Fed is looking at services, and they're looking at services ex energy and ex rent, which is really important because the rent component was up 10% annualized in this report. That's huge. If you look at analyst reports, they say that rent is going to actually come down, or it's coming down now, but that's going to flow through the CPI report probably around mid-year, which means the Fed is going to continue to do what they're doing. So they're focusing on that services component. That's where they need to see it come down. And they also need to see the labor market weaken. Hopefully it weakens with more people coming into the workforce instead of laying off more jobs.
Victoria, how long do you think it's going to take? We were talking to Mark Zandi last hour. He was saying that by next spring, definitely next summer, he doesn't think inflation is going to be a concern, that we will reach the Fed's target of CPI of about 2.5%. Do you agree?
Yeah, I don't think we'll reach it this year. So a call for 2024 would align with what we're thinking here at Crossmark. But again, I think so much of it depends on how far the Fed is willing to go. Are they willing to push us into a mild recession in order to get that demand destruction that they're looking for, you've got real consumer spending at over 3%. So that's not demand destruction that's happening. And we've got a dollar that's weakening, Seana. That means import prices are going to go up. That's a danger. Wages, import prices moving higher, rent staying high, all of that is a danger to inflation continuing to move higher. My thought that I want to really understand with the Fed is, are they willing to accept something higher than 2%? If so, perhaps we can pull forward that deadline a little bit. Are they willing to accept a 3% or something right around 3%? They say no, they're not changing their target, but I think if it goes too long, we might see a little bit of a change there in thought.
Yeah, you can't help but wonder. So the investment thesis in the face of all this is what?
Well, I think for one, it's be cautious. I think it's look at your portfolios and try to have that balanced approach to your portfolio. Have some fixed income allocation. You have the equity allocation, but have a diversified allocation there with some cyclical names, some growth names, some value names. That way, as the market does have the volatility, you're able to take advantage of that. And when you have certain names that run up, for example, Verizon ran up double digits last month, trim a little bit of those names, and then you can go into some names that have pulled back quite a bit that maybe have been on your shopping list and start building that up little by little.
All right, Victoria Fernandez, thanks so much for joining us here to react to today's inflation report.